Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to Bloomberg Businessweek with Massar and Tim Stenovec on Bloomberg Radio.
I want to shift gears a little bit, talk about venture capital, what's happening in the space, private equity, funds of funds. Here's a stat from 2023. Less than 0.5% of all VC funding awarded in 2023 went to Black founders. This is according to Crunchbase data. Women-founded businesses accounted for 2.2% of funding that year. That's according to PitchBook.
God, those are small numbers.
Tiny numbers. Illumen Capital is trying to change that. It's a Black-owned and led fund of funds that says it's, quote, working to achieve racial and gender equity across investing. Not just VC, but also growth and private equity funds. They've got a host of themes. They include education, financial inclusion, climate and sustainability, and more. We've got back with us Daryn Dodson, managing partner at Illumen Capital. He joins us from Oakland, California. Daryn, it's been a while since we spoke. How are you?
It's great to be back. Thanks for having me back.
Yeah, we love talking to you. I want to talk. I just want to start. I know you have a new fund that you recently raised, so we'll talk about that. But I want to talk big picture here, because if we were having this conversation, maybe 2021, about representation when it comes to venture capital, I think the backdrop was a little different than it is right now. We've seen a lot of companies come out in recent months and get rid of DEI initiatives. Huge companies, small companies, they get pushback from investors. It's almost like this idea of actually talking about differences has become something that's a little taboo now. How do you look at it?
Well, I think one of the benefits is that we have of science is that we have an approach that's a research-driven approach at Illumen Capital. And when we look at the data, one of the things that we see is that high-performing Black-led funds are overlooked and underestimated at significant rates. So this is in partnership with Stanford. We look at 180 asset allocators and found this as a consistent finding. So what that means is that companies that might back away from this area also risk looking at the important additive portfolio alpha generating characteristics of having top performing Black-led companies and funds part of their strategy and focus. So that's an important consideration for those that would shy away from this area that's critical to help portfolios outperform.
Daryn, help us out here. My understanding is that this latest Catalyst fund was maybe almost just under $33 million. I'm looking at a story by TechCrunch. I just want to make sure I've got it right. That you've got in total about $285 million in assets under management. And then back in 2023, you did $168 million second fund to address racial and gender bias in investing. Am I getting most of the numbers right here, or help me out here?
That's right.
So you've been doing this for a while, and that's a fair amount of money, right? Helping out entrepreneurs. What's happening? Like, where are these investments going? What's the reality of you make these investments and where they go? What kind of companies are created? Help me out. Tell me where this all goes.
So our new fund really enables us to look at direct investing, as about 35% of it goes into directs. Traditionally, we've invested in funds, which is where the other 65% goes towards. And we're looking specifically at first-time fund managers that have been associated with outperformance and overlaying our thesis of addressing bias in ways that unlock impact and economic value within the underlying funds. So again, the thesis of Illumen Capital is that if you're a pension fund or a sovereign wealth fund or a university endowment, all of whom we tested in our study and found systematically that they would overlook high-performing Black-led funds, we really want to enable them to have exposure to extraordinary entrepreneurs and extraordinary fund managers that they are most certainly, given the data of 1.3% of $82 trillion in capital managed by women and people of colored funds, they're almost certainly overlooking.
Where are you seeing the most opportunity right now when it comes to those numbers? Is it in the venture capital side or is it in the private equity side? Where is it?
I think within the venture side, there's a lot of explosion and growth, for example, within the Latinx community, leading new venture capital funds that are extraordinary in terms of being aligned with buying power trends that make up about 30% of the US GDP over the next 10 to 15 years. There's some wonderful data out of the Latino Action Business Network. LBAN is what we call it. It's associated with Stanford and kind of founded to look at 4 million companies per year and survey them on the bias that some of them face in terms of raising capital, either from banks, but particularly for this conversation, from venture capital funds.
So can I just ask you though, is it too early to see the impact that you guys are having when it comes to racial and gender bias, whether it's in hiring, investment? Like, I'm just curious. I know sometimes it takes a while for things in terms of the payoff, and I use quotation marks, but I'm just curious what impact you are actually seeing when it comes to gender bias or racial bias.
Well, we've seen the fund managers that we work with hire, promote, and retain extraordinary people. Mm-hmm. We've seen them select investments that would suggest that they're addressing bias within their overall selection process. And then finally, we see them create boards that really reflect the entire world and not just a sliver of the market. So those are really important areas where we expect over time to align with some of Charlie Munger's core thesis of compounding knowledge, which we work with all of our fund managers on, the strategies to address these biases and learn and commit to learning over time. And we expect that returns will follow as a part of our core strategy. It does take time, as we might learn from Warren Buffett and Charlie Munger, who have compounded returns over substantial amounts of time. And we see that also within our strategy, that the learning is followed by this commitment to achieve higher returns.
So let me ask you something, because I think about your mission is so clear, right? And you're putting your money where your mouth is, and you know what I mean, really trying to make this difference. I am curious too about a recent story that's been in the news. You're on the board of Ben & Jerry's, and the independent board of Ben & Jerry's has accused its parent company, Unilever, of silencing it on advocating for Palestinian rights in contravention of an agreement between the two. So I'm just like, I guess we're all just trying to figure out where we are in this world. What's your thought about this?
I can't comment on an ongoing lawsuit.
Okay.
Can you take us into at all the discussions that you were having ahead of the lawsuit with the board and what you were hearing, what you were talking about?
No.
It's okay. Next time, Daryn.
No, I guess, it goes.
I respect it. I understand.
We do. And I guess we're trying to understand like the bigger picture because of, certainly coming off the pandemic, of the murder of George Floyd, and just so many big corporate companies and their executives coming out and talking about the importance of this.
The reversal that we're seeing now.
And the reversal. So is it a complicated time? And we've just got about 30 seconds. I mean, you understand this, I think, from a very different perspective than most. And I'm just curious what you think.
Well, I think that given the political polarization right now and the increased inflation and also the real challenges with economic volatility, as a lot of folks are uncertain about the times to come. One of the things that we're sure of at Illumen Capital is it's environments like this that increase overall bias within heuristics of allocation portfolios. And one of the things that we're really proud of is enabling our investors like Health Ford Foundation and Ford Foundation to make even better investment decisions by focusing on addressing bias.
Thank you so much. Always appreciate time. Daryn Dodson there.
Let's talk about burgers.
Let's do that.
Okay, first up, we Americans eat a lot of them. About 50 billion burgers per year.
It's a lot.
Did you add this in? Did you edit my...
I did. You said read it, and I did, and I was like, I'm just curious. I just sat there, and I'm like, I wonder how many burgers we eat. You had a burger in the past week. I had a burger in the past week. I was thinking it was a burger.
That's an average of 2.4 burgers per person per day. That doesn't make sense.
Okay, that doesn't make sense. Okay, my statistics are a little flawed, apparently. All right, can we just stick with the 50 billion? All right, talk about cost.
Okay, I'm going to read the part that I that I wrote.
Okay, that was not Tim approved.
Okay.
This is Tim approved.
When it comes to cost, in the second quarter of 2024, the average price of a fast food restaurant burger was $8.41. It's up 16% from 5 years ago. That's according to the food consultant Technomics Ignite menu data.
That's a lot.
It's not just McDonald's, though. It's like, even at McDonald's, I should say, the price of a Big Mac. So no fries, no drink, just the sandwich. In June, Carol, that was up to $5.29, a 21% increase from 2019.
That's a lot. So beef may be what's for dinner, but it's more expensive than it used to be. I know it. I just go to the supermarket. You just get a feel, or even when you order it. So we have a guest who probably has some thoughts about that.
Yeah, Pat Conlin watches beef prices closely. He's president of Wayback Burgers, the fast casual chain that, yes, specializes in burgers, fries, shakes, and such. They've got about 150 locations here in the U.S., another 20 in countries including South Africa, Japan, Canada, and more. Pat, good to have you with us. How are you?
Thanks for having me.
Okay, so let's start with where Wayback fits in, because there's no shortage of burger options out there, from fast food to sort of the high-end gourmet and everything in between. Where do you play?
We play in the fast casual segment. In the
So the Shake Shack
burger-ish? Shake Shack,
Bear
Five
Burger.
Guys.
Okay.
We're still waiting in Manhattan. I'm just telling you.
Yep, very soon. You won't have to wait much longer. We're going to open up our first Wayback restaurant in Manhattan on 7th Avenue and 27th Street. Should be in January, right across from FIT. So then you'll be able to get one of those 2.4 burgers per day.
I don't know what that means. I'll have to double check on that. But talk fast casual, because, we talk about Chipotle, who is often credited with really creating it many years ago in terms of fast casual. It wasn't just the fast food places that we got accustomed to. It was a little bit of an experience.
Right. When I grew up, it was really fast food, and now fast food's called QSR, quick service restaurants.
Yeah.
Fast casual started really with Chipotle, Panera Bread, higher quality, elevated food, elevated experience in the restaurant, more fresh. People wanted a better quality burger, better quality salad to go to, and they're willing to pay more for that quality, but also for the overall experience and the atmosphere of the restaurants.
How do you replicate that atmosphere of the restaurant in New York, where rent is super high, spaces are small, and crowds are aplenty?
You have to be fast. So even though we do the order, we don't pre-cook any burgers. We make the burger when you order it at the point of sale system. But it's really, nowadays, the digital ordering process is a big portion of our business. So people ordering ahead on the app.
How much of your business
online.
is that?
It's about between the app and online ordering and delivery. It's about 40% of our business is digital orders.
How much is that up just in the last few years?
Wait, online, app, and delivery are 40% of the business?
Correct.
Okay, forgive me. Go ahead.
And when you do delivery, are you doing third-party delivery? Who do you
Third party
use?
through Uber Eats, Grubhub, DoorDash.
Do you hate that and paying all those fees? Can I just
Well,
put
we
it
pay
out
the
there?
fees. We pay the fees.
I know, but
Both of us pay the fees.
Yeah.
The restaurateur pays commissions to
It's like-
those services, but we don't. I mean, if you had to start a delivery service of your own, there's a cost involved in that as a restaurateur. Delivery guys, insurance, cars, things like that. So there is a value to having them, and they bring certain guests to, maybe not to the restaurant, but they bring those sales into the restaurant, because there are certain people that are only going to order delivery. Mm-hmm. And when I was a kid, the only thing you could get on delivery was Chinese food or pizza. Now you can get everything under the sun.
It is so true, right? In
Yeah.
terms of diversity. I have to say something. Excuse me as I blow my nose. Sorry, I'm getting cold. Five Guys, In-N-Out, Wayback Burger, Smash Burger, Burgerville, Fat Burger, Johnny Rockets, Whataburger, Red Robin's, Hardee's, Jack in the Box, Wendy's.
Well, now you're getting to some fast food.
Okay,
Yeah.
but I'm just going to say, there are so many burger joints out there. How do you, I understand fast casual and experience, but how do you stand out? Like, what's your fear about coming into a New York market when I can also go to PJ Clark's and get a burger with béarnaise and be at like kind of an old speakeasy and have a really cool experience? But tell me how you do it.
Well, it has to be done, I mean, in the fast casual segment, and even in the QSR, quick service restaurant service now, quality, everybody has quality food. Okay, so
No, everybody does not have quality food. But go ahead.
Everybody has some semblance of quality, or
There are
people
some
expect.
regulations.
She'll fact check you.
People expect quality for the level of price they're paying.
Yeah, okay, fair.
So you have to have something other than just quality food. You have to have the atmosphere. You have to have that guest service We don't call the people that come into our restaurant customers. We call them guests because we really believe that they're coming into our dining room at our home. When you order at the POS station, we don't give you a number, we take your name. So it may sound a little bit goofy, but it's a little bit different personalization. So then when we walk the food out to your table, we say, Pat, double cheeseburger, not number 21, number 27. So it just, makes you feel a little bit better as a guest. And then if you walk in and that person behind the POS system remembers your name, or maybe they remember that you get a bacon double cheeseburger all the time and an Oreo milkshake, and they say that and you're in with somebody and they catch your name, or hey, you're getting that thing, that same order, makes you feel like a king as the guest. So that's how you have to differentiate yourself today in the market. We know we have a great burger. We know we have great hand-dipped milkshakes made the old-fashioned way in a metal tin, spun, not pulled out of a machine. So we know we have quality food. It's that other atmosphere and that sense of nostalgia that's going to set us apart.
You're a franchise guy.
Yes.
That's
all my life.
Your whole life, yeah, your whole career. What's the franchise model here?
In terms of?
So how does it work? I mean, are these all independently owned and operated? Are they company stores?
No, we're 100% franchise.
Okay, 100% franchise. So an asset-light model for you on the corporate side. How do fees work?
The
franchise fees.
Initial franchise fee, the license to open up a restaurant, is $35,000.
Okay.
Your ongoing royalties are 5%, and the advertising fee is 4%.
That's pretty typical to the industry.
Correct.
So all you need is $35,000 up front in order to do it, plus the capex that you need to build out your location.
Yeah, the total investment is between $550 to $650.
Okay.
Including the franchise.
How do you explain the footprint where restaurants are right now in the U.S.? Is that because of who you found as franchisees? Is that deliberate? It's definitely, there are a lot, but they're concentrated in certain areas.
Yeah, we concentrate, except for the one that we're doing in Manhattan. We started in 1991 in Newark, Delaware. We've always been very successful in small towns. We are opening up the one in Manhattan, opening up one in New Orleans. So those are really our first forays into downtown areas. And we've been successful, but now through that downtown, through those small markets, now we're growing into the cities.
Who are you seeing as your typical franchisees? Are there a handful of people who have like 10 of them, or are they sort of one-offs?
No, we're a little bit different than some other franchise companies. We look to award one franchise at a time, where many other companies want you to come in and do 5 or 10 or take down a whole county. We want to be in business with you first, see how you do, see if you're happy with us, we're happy with you. We're all about growth, but we want to make sure we're growing with the right people. So we do one at a time.
Does that mean you do have some franchise operators who have more than one?
So now over those years since we've been franchising, since 2008, we're about 45% of our system are multi-unit franchisees. So they've reinvested in the brand and themselves. They know that it's working and they're happy and we're happy with them.
And you do stuff over internationally too, like Brunei, Ireland, South Africa, Japan, Canada.
Yeah.
And you're continuing that. Like, how do you what's that model? And
that model's model's a little bit different than the franchisee in the U.S. It's done by a master franchisee, and that person or that company actually becomes really the parent company in that country or that territory or that province. So they have to do everything that we do in the U.S.
Interesting. How quickly does somebody who sets up a restaurant, a franchise, and how quickly do they get their money back?
Really depends upon how they set up. If they're an owner-operator and they're taking a salary, or if they're multi-unit owners, it's a different payback and how they set it up financially, whether they're paying all cash for it, using their own money, or if they're going to the SBA or a lending institution for financing.
Is the model such that the franchisee is actually in the back working, getting his or her hands dirty?
No,
Does that need to happen? There's some
they
chains are notorious for that.
They need to know. Yes, they need. When you become a franchisee, you're going to have to learn how to flip burgers and drop fries and make milkshakes. The reason being, not that that's going to be your function as a franchisee. Your function is to grow your business and to get a new guest every day. But you need to know, because when you walk in or when you look on a videotape and you see that that the side of the floor is dirty because they've been hitting it with the mop and not cleaning that, you need to walk in and be able to catch that. So you need to go through the full training process. But no, we don't expect our franchisees to be in behind the grill every day. That would be a waste of their talent and their training.
We got about 30, 40 seconds, and then we're going to take a break and come back and talk some more. Do most franchisees work out, or are there a small percentage where it's just obvious? Because you got to worry about the brand, the reputation. One bad one can bring it down. So I'm just curious, do most of them, like 90% of them, work out?
Most of them, yes, they do work out, and we have a great family of franchisees across the U.S. and across the world. Yeah, there are some times where people either decide this isn't for them, or it is a lot of work. The restaurant business is a lot of work.
Yeah.
And you also have to have a personality to be in the restaurant business. It's not, you're not behind a desk. You have to be, out there, front man.
Yeah.
And if that's not for you, then you shouldn't get into the restaurant business.
I want to get back to our guest. Still with us, Pat Conlin, president of Wayback Burgers, 150 locations and counting in the United States. And I'm just going to tell you, we're still talking about that 2.4 burgers per day. I have found it, USDA data. I have never been grilled so hard.
Ooh, I like what you did.
The little pun.
That was really good. Okay.
Pat, talk to us about some of the logistics of, as Tim rightly pointed out, it's franchisees, so asset light. But I am curious about food costs, labor costs, building out in, as you said, you're getting ready to open up or have one location in New York City. It's expensive here in New York City. Talk to us about some of these dynamics.
Yeah, well, the food cost is, again, one of the reasons you get into a franchise model is we go out and we negotiate for 150 restaurants for beef, for buns, for ice cream, for soda, for all the supplies. So you're not, if you were going out and just negotiating for yourself, you wouldn't get that volume discount purchase. It also talks to the quality of the product because we're getting the quality, the consistency. So you get that same burger, the McDonald's theory, whether you go to one in California or whether you come to one in New York or Florida, you get that same taste. Same thing with Wayback. It is the same product across the U.S. So you get the volume discount in the pricing. You get the same quality and the consistency which the guest is looking for when they walk into a Wayback or any franchise model. And I forgot what the other part of your question was.
Labor costs.
Labor costs.
And even overhead of building out. It's not going to probably cost the same to build in New York versus maybe somewhere else across the United States. Or does it? I don't know.
No, New York City is a different
Crazy
animal to itself, but it was an existing restaurant, so those are some of the spaces that we look for around the country, as long as it can't compromise on the quality of the location. It has to be a number one location, AAA location, and if it was a restaurant location, great. You don't want to take a second generation restaurant that went out of business because it was a bad location, but it's going to save you $50,000 in build-out costs.
So you do research. You're like, okay, who was here beforehand, right?
Yeah, and why did they go out of business? Is it in the back end of the shopping center? Was it a bad shopping center? Can you make a left-hand turn? Is there a light to get in, to get out? Or are you taking your life in your hands if you have to pull your car out of that shopping center? So we do all that research along with our broker networks. We have a real estate platform, a modeling platform that looks at the locations that we're choosing with the franchisees. And we hold their hand all the way through that. You asked earlier what type of people are coming into the system. It really spans the horizon. There are restaurant people that come in. There are people that come out of corporate jobs. There are people that come out of IT. It's really all across the board. But we have the training programs and the systems to be able to make them successful.
Okay, lots of questions here. You mentioned labor.
Yeah.
I want to hone on that a little bit because we've seen labor costs over the last few years go up quite a bit. It's been tough in some markets, even finding the labor. What's the labor picture you're hearing from franchisees right now?
One of our franchisees told me about 6 months ago that I said, and our first franchisee opened up in Utah about a year ago. And I asked him, is there any labor problems, labor issues, finding labor in your market? And he said, Pat, there's no labor issues. It's you have to pay what the going rate is in the area. And that's really what it comes down to. If a restaurant down the street is paying 25 cents more an hour than what you're offering, you're going to have a labor problem. Minimum wage is a fictitious number. There is no
Yeah,
minimum
because the
wage.
market determines that.
Correct.
We found. But if, let's say, you're a franchisee in a part of Utah where the cost of living is higher, has to pay a higher wage than somebody based in, let's say, a Sunbelt state where you have a store, where the cost of living is lower, is that reflected in the actual menu price too? Do they have discrepancies, or do they have the ability to have discrepancies within menu pricing?
Absolutely. We don't force them to charge X amount for a burger or a milkshake. Labor has to be taken into account, just like rent has to be taken into account. The rent in New York City is going to be much different than the rent in North Carolina. That has to go into the menu prices. The food cost goes into the menu prices. We were talking earlier about the price of beef and the price of proteins and how that has gone up over the last 3-4 years. So that has to be accounted for, and you see that in menu prices and inflation and things of that nature.
I was looking at the menu. The menu looks great, by the way. It got to a part though where it had the non-meat burgers. Carol and I used to talk about these all the time.
Now it
Does anyone order these anymore?
That's a great question.
They still do. The Impossible.
The Impossibles and the
plant-based.
Beyonds?
Yeah, the plant-based. We carry the Impossible Burger. And probably 3-4, just right around the pandemic is when we brought it on.
That's when it was hot.
Yes, and it probably went up a couple of years after that. It's funny, we had it on as a limited time offer just before the pandemic hit, and we weren't sure how it was going to go. And it was also going to be an expensive menu item because that product was an expensive item to bring into the restaurant. And it turned out to sell very well. And we took it off because we had a limited amount of supply of it, and never saw so many feedbacks 4 or 5 years ago. When are you bringing that back? The only reason I came into a burger place was I saw that you had that online. Now that has definitely waned, and the plant-based meat alternatives have gone down somewhat.
It's so I don't know about you, Carol, but I went from I loved those things, and then I kind of realized what was in them. And
I was never a fan.
For me, now I'm like, give me the cow.
Yes.
I was never
Give me the cow.
No, because I thought the amount of salt that was in it, and I had so many conversations with folks that were in the industry, and I'm like, I should be your customer, but it isn't a healthier option.
Yeah, we have. Well, it's
At least
really
for me.
it's really for people who are not they're not vegetarians. They like meat. They like the taste of meat. They were looking to cut down their consumption of meat and going that way. So it worked well for us.
So I'm looking at a
we'll
sweet
see.
bacon burger that's just oozing with bacon and cheese. Looks kind of yummy. Cheese fries. Yep, give me some fries.
Get the bacon on the fries.
I'm just saying, what happened to people wanting healthier fare?
It's
I think this is looked at as healthy now.
Come on. No, to be fair,
We
like,
gotta
healthy.
ask RFK.
We've only
What's
got
healthy?
We've only got about 30 seconds. Like, what?
people looking, and they want to eat healthy in January when they get their gym membership, and when the calendar changes. Come February, everybody's back to eating those 2-3 burgers a week.
Just sorry. Go ahead.
Or 2.5 burgers per day.
2.7.
I'll take the 2.7.
I'm just saying. Really interesting stuff, and fun to hear you kind of talk about your business. And we didn't really get to say how it's changed from '91, but come back soon.
Yes, definitely. Thanks for having me.
But
But
bring
we'll
some
still be
cheese
doing
fries.
math. When you get back, we'll still be working on this math problem. Okay.
It's right. We'll get into it.